If I look backward, as you well know, Tesla accounts for almost a fifth of the return that you have generated in that 5-year time span. Which of your current holdings, Cathie, do you think will supply the biggest lift in the next 5 years?
Tesla's still in the running, but I would have to say the biggest upside surprises are going to come from the genomic space. And that's because the convergence of DNA sequencing, artificial intelligence, and gene therapies, importantly CRISPR gene editing, are going to cure disease. That convergence is going to cure disease. Now we have real science and technology surfacing the mutations in our genomic profile. And as they surface those mutations, what do we see? We see the earliest manifestations of disease. And now, with the combination of artificial intelligence and gene editing, we're able to both anticipate diseases and cure them potentially. Beta thalassemia, we're seeing it, sickle cell disease. We even think it will work in diabetes, which is where most, if you look at the largest category of spending year to year in healthcare, it's diabetes.
Cathie, another surprise for me in your portfolio attribution is that almost none of your performance, just 20 points out of 600 points, is from Apple, Microsoft, Amazon, and Facebook, the 4 biggest contributors to the S&P 500 over the same period. What about them doesn't make the grade for Cathie Wood and for ARK?
And they were a part of our portfolios in the early days. But as they were scaling into the $1 trillion category, we believed that our research would be focused better on the next set of FANGs. And I don't mean FANGs meaning in the internet age. We actually think the next FANGs are in the genomic age. And if you'll notice our flagship portfolio, the largest exposure is healthcare for that reason.
What would make you reconsider investing in those stocks?
What would encourage us to move back into that ilk of stock is a continuation of what we're seeing now, so that some of our valuations become stretched beyond our minimum hurdle rate of return. So our minimum hurdle rate of return for any stock entering our portfolio is 15% at a compound annual rate over the next 5 years. So that's the doubling over 5 years. We're not there yet, but if we're in the low 20s, which is much more than a doubling over 5 years, but if we started seeing more and more of our stocks lose that return expectation and drop below 15%, we would move back towards some of the FANGs and Microsoft because we would be treating them essentially as cash-like instruments for our strategy. So what we do is, as a bull market extends, we do move into more cash-like equities. They would be the less volatile stocks, and certainly the FANGs and Microsoft fit that. And we would do that increasingly.
In August of 2018, you tweeted a letter to Elon Musk in which you effectively put a price target on Tesla of $4,000. And that call arguably made you famous, but it also exposed you to a world of hate on Twitter. Any regrets?
Oh, no, not at all. I didn't read the Twitter world of hate notes to me. Our marketing department used to send me anything that I needed to respond to. But no, we were standing up for what we thought was right. And we also were astonished that at the backlash. And I think part of it was Elon's personality and the way and the things he was saying on Twitter. He's a provocative soul, and he's brilliant. He's our Renaissance man, and all we did, which is what we should have done in terms of our research, is keep our eye on the prize. And the prize had to do with the autonomous taxi network that we believe Tesla will be in the pole position to dominate. mostly because of its advantages in artificial intelligence and the amount of data it has collected and the AI expertise that it has. And we couldn't believe that no one wanted to listen to this, that they really just made fun of it. And it made me feel even more strongly about Tesla, because what we saw happen over time as the naysayers were growing was their barriers to entry, or Tesla's barriers to entry, were increasing. Their battery technology was already 3 years, now it's maybe 4 years ahead of the competition. The first AI chip, no other auto manufacturer has an artificial intelligence chip for autonomous. They now have 15 billion miles of real world driving collected. Google, the next closest, has about 25 million, 15 billion. The winner in autonomous is going to have the most data and the highest quality data. That company right now is Tesla. So way back then, our confidence was high that they were heading in the right direction. And as the naysayers grew, it was after 2018, through into 2019, as the stock was cratering, as many out there were saying Tesla was going to run out of money. We thought that was a ridiculous concept. The only time a company like Tesla will run out of money is if the market shut down. There were companies that ran out of money in 08, 09 because the markets were closed. The markets were open. We were going to support Tesla if they did an offering. So were many others. So, I mean, they were creating stories that were just ridiculous on the face of them. So, no regrets whatsoever.
You believe there are 5 technology platforms that are changing the world: artificial intelligence, robotics, energy storage, DNA sequencing, and the blockchain. But of course, technology isn't static. If there's a 6th, what would it be?
Well, we're looking closely at quantum computing because I've been in the business a long time, more than 40 years, but for the last 20 years of those, we've been examining quantum computing. I'd be at the World Economic Forum technology conference in China, and, professors from around the world focused on the next big thing. They were more transparent, and after 08, 09, investors wanted more transparency. Investors wanted more liquidity. Unlike mutual funds, they trade all day long. They're lower cost than mutual funds because they didn't have any hidden fees. The fees, what you see is what you get. And they were more tax effective. And so for those 4 reasons, I just asked the question, why aren't we doing why don't we put our fund into an ETF? This sounds like a good deal for the end investor. And that's what got me questioning, hey, AllianceBernstein, what are you doing about ETFs? Are you thinking about active and so forth? And that's how we fell into that conversation.